Ladies and gentlemen, stop what you're doing. The missiles have launched. The airstrikes have begun. And while the world watches explosions on their screens, something else just detonated, something far more dangerous than anything happening in the Middle East right now. The financial markets didn't just react, they broke. Gold spiked. Oil futures went vertical. Treasury yields inverted in ways that shouldn't be possible. And then, for exactly 7 minutes, the silver market stopped. No trades, no movement, just silence. That doesn't happen by accident. That's not a technical glitch. That's what happens when the people controlling the system realize they've lost control. Let me walk you through what just occurred, because the headlines won't tell you this part. They'll show you the missiles. They'll show you the burning refineries. They'll interview generals and politicians. But they won't show you what happened in the 30 seconds after the first reports came through. They won't tell you about the $184 billion that just evaporated from emerging market bonds. They won't mention the emergency liquidity injections that 3 central banks authorized before dawn, and they definitely won't explain why gold moved $67 in under 4 minutes, while silver didn't move at all. This is where things stop making sense. This is where the official story and the actual story split into 2 different realities. The surface narrative is simple. U.S. forces launched precision strikes on Iranian nuclear facilities. Iran retaliated by hitting Saudi oil infrastructure. The Strait of Hormuz is now a conflict zone. 20% of global oil supply is at risk. Markets are responding to geopolitical risk. Fear is driving safe haven flows. This is what you're supposed to believe. This is the story that keeps the system looking rational. But here's what that story doesn't explain. It doesn't explain why gold futures contracts worth $2.3 billion changed hands in the first 90 seconds. It doesn't explain why 3 major European banks simultaneously suspended redemptions on Middle East-focused funds. It doesn't explain why the Shanghai Gold Exchange saw buying pressure that exceeded its entire average daily volume before Western markets even opened. And it absolutely doesn't explain why several major bullion dealers quietly removed their online pricing for silver bars larger than 100 ounces. Someone knew, someone was positioned, and someone just made an amount of money that would make your head spin. Let me give you the timeline, because this is where it gets really interesting. The first missile launches happened at 3:47 a.m. Eastern Time. At 3:51 a.m., gold was up $22. Normal fear trade, predictable. Then at 3:52 a.m., something changed. Volume exploded, not gradually, instantly. We went from 14,000 contracts per minute to 91,000 contracts per minute. In 60 seconds. That's not retail investors waking up and panic buying. That's institutional flow. That's algorithmic execution. That's someone who had their finger on the trigger before the missiles even left the ground. And here's the part that should terrify you. While gold was going vertical, silver froze. Not slow, not choppy, frozen. The bid-ask spread on silver futures went from 7 cents to $4.30. $4 on a metal trading at $29. That means the people who make markets, the people who are supposed to provide liquidity no matter what, backed away. They stopped. Because they didn't know where the real price was anymore. When market makers disappear, that's not fear, that's information asymmetry. That's the moment when the insiders realize the outsiders might figure something out. Now let's talk about oil, because this is where the narrative really falls apart. Brent crude spiked to $97 per barrel in the first hour. Everyone expected that. Iran threatens the Strait of Hormuz, oil goes up. Simple, except it didn't stay up. By 7 a.m., crude had fallen back to $89. In the middle of an active military conflict, while Iranian drones were still in the air, while Saudi Arabia was declaring a state of emergency, the price fell. That doesn't happen unless someone knows something the market doesn't. That doesn't happen unless the real players, the ones moving billions, not millions, understand that this conflict has already been priced in. Or worse, that this conflict is exactly what someone wanted. Because here's what nobody's saying out loud. The United States has been sitting on strategic petroleum reserves at generational lows. 17 days ago, the Department of Energy authorized the largest refill operation in history. They started buying oil, quietly, through intermediaries, at $73 per barrel. And now, 3 weeks later, oil hits $97, and they're sitting on a profit of $340 million per million barrels purchased. That's not luck, that's timing. But it gets stranger. In the 72 hours before the strikes, 4 major hedge funds that specialize in energy commodities increased their put positions on crude by 340%. They were betting on oil prices to fall in the middle of rising tensions. That's either insanity or inside information. And these people don't do insanity. Let's go back to gold for a second, because something happened there that I need you to understand. After that initial spike to $67 above opening, gold didn't pull back. It should have. Every geopolitical shock in the last 20 years has followed the same pattern. Spike, panic, pullback, stabilization. but not this time. This time it held. It consolidated, and then it broke higher again. We're now sitting at $2,191 per ounce. That's not fear, that's conviction. And the buying isn't coming from where you'd expect. It's not American funds. It's not European money managers. The flow is coming from Asia, China, Singapore, Hong Kong. The Shanghai Gold Exchange premium, the amount Chinese buyers are willing to pay above the international spot price, just hit $47 per ounce. That's the highest premium since 2016. They're not buying because they're scared of a war in the Middle East. They're buying because they know what this war represents. This is the moment. This is the event that breaks the dollar's monopoly on crisis management. For decades, when the world panicked, it bought dollars, treasuries, safe haven. But look at what's happening right now. 10-year Treasury yields are rising in the middle of a military conflict. That's supposed to be impossible. Fear is supposed to drive yields down as everyone rushes into bonds. Instead, yields are climbing because foreign holders are selling, not slowly, not carefully, aggressively. In the last 16 hours, we've seen $11.8 billion in Treasury liquidation from non-US accounts. Japan, South Korea, Taiwan. They're not selling because they don't like treasuries anymore. They're selling because they need dollars right now to defend their currencies, because the dollar spiked so hard, so fast, that their central banks are burning through reserves just to keep their exchange rates from collapsing. And here's the trap. The Fed can't help them, not without restarting swap lines, not without admitting that the global dollar system is under stress. And the moment they do that, the moment they publicly acknowledge the problem, it becomes a crisis. So they stay quiet, they let these countries burn their reserves, they let the pressure build. This is what currency warfare looks like in real time. This isn't missiles and tanks, it's liquidity and interest rates. And the casualties are measured in trillions, not thousands. Now, silver. We need to talk about what happened to silver because this might be the most important part of the entire story. After that 7-minute freeze, silver came back online. And it didn't explode upward like gold. It crept slowly, painfully, like something was holding it down. We're talking about a metal that's supposed to be more volatile than gold, that usually moves twice as fast on geopolitical shocks, and it's barely up $1.80. That's not market behavior. That's intervention. That's someone sitting on the price, absorbing buy orders, keeping the chart calm. Why? Because if silver breaks $32, the real panic starts. Because that's when industrial buyers stop waiting. That's when the electronics manufacturers, the solar companies, the EV battery producers realize they can't wait anymore. They have to lock in supply now. And there isn't enough supply to meet that surge. Global silver inventories at major exchanges have dropped 34% in the last 11 months. COMEX warehouses are at 15-year lows. The London vaults are being drained at 4.2 million ounces per week. And now we have a war that's threatening the refineries in the Middle East that process silver as a byproduct of copper and zinc production. The physical shortage was already critical. This just made it exponential. But the paper market is still pretending everything's fine. The futures contracts are still trading. The banks are still writing options. The system is still functioning. On the surface, underneath, it's screaming. Because here's what the data shows. In the last 6 hours, the ratio of paper silver claims to physical silver available for delivery just hit 389 to 1. That means for every ounce of actual metal in the warehouse, there are 389 different contracts claiming ownership of that same ounce. That's not a market. That's a Ponzi scheme. And the moment someone demands delivery, the moment a major player says, I don't want cash settlement, I want metal, the entire structure implodes. And someone just started asking for delivery. We don't have names yet. We don't have confirmation. But the standing for delivery notices at COMEX for March contracts just jumped by 11,000 contracts. That's 55 million ounces. And there are only 62 million ounces registered as available. If those deliveries actually happen, the warehouse goes to 7 million ounces. And April contracts, which settle in 5 weeks, are already sitting at 8,000 contracts open. The math doesn't work. The system doesn't have the metal. And now we have a war that just gave them the perfect excuse for force majeure, for emergency suspensions, for cash settlements instead of physical delivery. This wasn't an accident. This was engineered. Let's zoom out for a second. Let's talk about what this conflict actually means on the macro level, because this isn't about Iran's nuclear program. It's not even about oil. This is about the end of the post-2008 monetary order. This is about the final breakdown of the system that's been held together with central bank liquidity and dollar dominance for 15 years. China hasn't condemned the strikes. They haven't supported them. They released a statement calling for de-escalation and dialogue. Neutral. Carefully neutral. Because they don't need to pick a side. They've already won. They've spent the last decade building alternative payment systems, stacking gold reserves, signing bilateral trade deals that bypass the dollar. And now, while the US is dropping bombs and burning political capital, China is signing an energy agreement with Saudi Arabia denominated in yuan. The Saudis, the cornerstone of the petrodollar system, the country that promised in 1974 to only sell oil in US dollars in exchange for military protection. They just agreed to accept yuan, not as a test, not as a token gesture, as a primary settlement currency for crude exports to Asia. That's the real explosion. That's the bomb that actually matters. Because once that door opens, once the precedent is set, every other oil producer starts asking the same question. Why are we holding dollars? Why are we eating inflation and currency risk just to support America's reserve status? The dominoes are falling, and this war just gave them permission to fall faster. Gold is going to $3,000, not because of fear, because of realization. Because the world is watching the most powerful military on earth launch a war it can't afford during a debt crisis. It can't solve while its currency loses credibility in real time. That's not a recipe for safe haven flows into dollars. That's a recipe for flight. Silver is going to break. Maybe not today, maybe not this week, but it's going to break. Because the industrial demand isn't going away, because the green energy transition isn't stopping, because every solar panel, every EV, every 5G network needs silver, and the supply chains just got cut. And when it breaks, when the price finally moves the way the physical market says it should, the paper holders are going to panic. The ETFs are going to face redemptions they can't meet. The banks are going to declare force majeure. And the people who waited for proof, who wanted confirmation, who needed the mainstream to tell them it was real, they'll be the last ones in line, staring at premiums they can't afford and wait times they can't accept. This is not a drill. This is not a geopolitical blip that fades in 3 days. This is the moment when everything we've been watching, the liquidity problems, the currency tensions, the supply shortages, the central bank desperation, converges into a single crisis that nobody can ignore anymore. The war started, but the missiles aren't the weapon. The real weapon is already inside the system. It's been there for years, and it just went active. I want you to think about something. In 2008, when Lehman Brothers collapsed, the panic was instant. Markets froze overnight. Credit stopped flowing. Everyone could see the crisis. Everyone understood the danger. But this time, it's different. This time, the crisis is moving in slow motion. It's hiding in premium spreads and delivery delays. It's buried in footnotes about force majeure and cash settlement clauses. It's disguised as strength while the dollar surges and crushes foreign currencies. But make no mistake, the violence is the same. The destruction is the same. It's just distributed differently. By the time the average person understands what happened, by the time the pension funds and the retail accounts realize their safe haven wasn't safe, by the time the system admits that the emperor has no clothes, the people who positioned early will already be unreachable. The maps will keep showing missile strikes. The headlines will count casualties. The politicians will give speeches about national security and strategic interests. And beneath it all, beneath all the noise and theater, the largest wealth transfer in modern history will complete